Hi, I'm Joe, and in this video I'm going to go over the meanings of assets and liabilities and show you how knowing the difference can benefit you financially. So what's an asset? An asset is something that adds value to an individual, company or country. The value being economical or monetary value, which means it's worth money. Examples of assets are rental property or dividend stock or anything that you bought outright that you own. Now, what is a liability? A liability is something that an individual or company owes, usually money. Examples of liabilities are a mortgage for a house, loans from the bank, or warranties. I'm sure most of you have heard of net worth. If you're subscribed to the channel, you should have definitely heard of net worth. And net worth is actually calculated by subtracting your liabilities from the total value of your assets. Okay, the thing with these definitions, these are the so-called proper definitions of assets and liabilities. Most people don't use them for their proper terms. They use them in a bit more of a general term, a loose term. They'll use it in the sense that asset means everything you own and liabilities are everything you might have to pay for in the future. And then this can lead them to be confused as to which one is costing them money and which one is actually making them money. The importance of understanding the difference between assets and liabilities can't be underestimated. In the business world, you want your assets to actually make you more money. You want a return on assets, an ROA. And then in contrast, you want to keep your liabilities to a bare minimum. However, sometimes it's actually quite useful to acquire a liability. Sometimes it's necessary to acquire a liability. This is so maybe you can raise capital with a loan or maybe a rental agreement with a warehouse so you can expand your business. Same thing applies for a larger workspace like an office, so you can have more employees working all in the same space. You acquire this liability so that you can expand and grow the business. In this book that is called Rich Dad Poor Dad, Robert Kiyosaki's #1 lesson arguably is to know the difference between assets and liabilities. This is so that you can read a balance sheet properly and accurately and know what it means. He says the rich people acquire assets and the middle class acquire liabilities that they think are assets. The biggest example he gives in this book is a house. Most people buy their first house when they have saved just enough to buy a house. They use up all their savings, which is bad because you've just used all your capital and you've locked it away in something that you won't be able to get an immediate return on, and it isn't going to generate passive income. If you want to know what he suggests and much more from the book, then I highly suggest that you read the book. And if you do want to, there will be a link in the description below, an Amazon affiliate link, and click it and just buy it. It's like £5. It is probably the best book to get to grips with personal finance. So you want the goal to be to acquire assets and reduce liabilities. And the assets that you do acquire, you want them to be money-making assets. But if you can, try and turn a liability into an asset. For example, if you have a house that you pay a mortgage on, then maybe rent out one of the rooms to generate some extra money that's going to be put into your pocket. You're taking advantage of an opportunity to make money off a liability. You're turning a liability into an asset. Hopefully that video explained what liabilities and assets are, and if you did find some useful information, then please make sure to smash the like button. It will help me out a lot and help more people know about the difference. And when you're down there, make sure to hit that subscribe button if you're into these kind of videos and if you want to know more about finance. Personal finance. I'm not a finance advisor. The things that they don't teach at school. Thank you for watching, and I'll see you in the next one in a bit.